It's been a wild ride, to say the least. Gold and silver have just experienced a spectacular fall from grace. It happened so quickly it left many of us feeling a bit dizzy. Just last week, we were watching gold flirt with record highs, pushing past an incredible $5,500 an ounce. But then came Friday. In a single brutal trading session, the price of gold plummeted. It was a historic drop. The metal fell by over 11%, a staggering $600 loss in one day, to close at around $4,745 an ounce. This wasn't just a small dip, it was a full-blown cratering. If gold's fall was shocking, what happened to silver was simply breathtaking. Silver's move was even more dramatic, a supercharged version of gold's decline. It had enjoyed a parabolic run, then saw its value slashed by more than a third. At its lowest point on Friday, silver was down 35%, trading around $74 an ounce. The market felt like a trapdoor had opened underneath it, swallowing months of gains in a matter of hours. These days are rare, but they remind us how markets work. When everyone is on one side of the boat, it doesn't take much to tip it over. Momentum to dizzying heights suddenly reversed with terrifying speed. For weeks, the story was how high precious metals could go. Now the conversation has completely changed. Everyone is asking two questions: what just happened, and more importantly, what happens next? The shockwaves from this sell-off are still being felt. The sheer scale of the drop has rattled investors. After seemingly unstoppable gains, where it felt like you couldn't lose, this was a harsh reality check. The journey from $3,000 to over $5,500 for gold had been so smooth that many forgot corrections can be this severe. It was, as one analyst put it, more of a melt-up than a traditional bull market. And as we've just seen, what melts up can also melt down. So why the sudden collapse? It wasn't just one single thing, but rather a perfect storm of factors coming together at once. The first and most straightforward reason is simple profit-taking. When an asset like gold rallies so far, so fast, many investors who bought in earlier are sitting on significant gains. When an asset like silver rallies so far, so fast, many investors who bought in earlier are sitting on significant gains. It's only natural for them to want to lock in those profits by selling. This creates a wave of supply in the market. Once a bit of selling starts, it can trigger more selling, creating a domino effect as traders rush for the exits to protect their gains before they evaporate. Another key element was a specific news trigger. In this case, reports about a potential new nomination for a key financial post in the government seemed to be that catalyst. While the news itself might not seem directly related to the price of gold, it was enough to spook a nervous market. Traders used it as the signal they were waiting for to unwind their positions. It validated the old saying about the fast up, fast down nature of these parabolic moves. The market had been wound up like a spring, and this was the event that finally released the tension. Beyond the news, there were also technical warning signs flashing red for weeks. One of the most watched indicators is the Relative Strength Index, or RSI. Think of it as a momentum gauge. When the RSI gets too high, typically above a level of 70, it suggests that an asset is overbought and the rally might be running out of steam. In the days leading up to the crash, gold's RSI had soared to 90, its highest level in decades. This told technical analysts that a correction wasn't just possible, but highly likely. The market was stretched to its limit, and a pullback was overdue to bring things back to a more sustainable level. Finally, we have to look at the unique situation with silver. For the fifth year in a row, the world is using more silver than is being mined, creating a supply deficit. This is driven by massive demand from industrial sectors, especially for solar panels and general electrification. Because most silver is mined as a byproduct of other metals like copper and zinc, miners can't just ramp up production when the price of silver goes up. This underlying physical tightness means that while the paper market can swing wildly, the real-world supply and demand dynamic provides a fundamental anchor. In the aftermath of such a dramatic sell-off, the big question is whether this is the start of a new bear market or just a healthy correction. To figure that out, let's look at what major financial institutions are saying. Many big players remain surprisingly bullish for the longer term. JP Morgan has reiterated a positive outlook. They say fundamentals for owning gold haven't gone away. JP Morgan sees prices pushing back toward $5,000 by year-end, and they even project a potential $6,000 target further out. They argue the core drivers of the rally are still intact. Continued strong demand from central banks around the world. Central banks are still adding gold to their reserves, as a way to diversify away from currencies. Investor demand is expected to remain robust. Scottsdale Bullion & Coin compiled forecasts from 26 institutions. The consensus average target, about $5,550 by end of 2026. That implies the crash may be a temporary, painful interruption, but not everyone thinks the pain is over. Heraeus takes a more cautious near-term tone. They expect a period of reset and consolidation after the rally. Prices could trade sideways, or even drift a bit lower as the market digests the moves. Momentum has been broken. It will take time for confidence to return. A new, stable base needs to form before a big move higher. Standard Chartered strategist Manpreet Gill notes technicals looked overbought. Gold was deep in overbought territory. Silver was also deep in overbought territory. The view here, correction was overdue to flush speculative excess. Expect weeks or months of choppiness and uncertainty. The market must find a new equilibrium where long-term buyers re-enter. Short-term view, caution. Longer-term outlook, broadly positive. So, where does this leave us? Is the bottom in, or is there more pain ahead? The most honest answer is that in the very near term, we should probably expect more volatility. A drop of this magnitude rarely resolves itself in a single day. It's common to see sharp bounces followed by more selling. Traders who were burned by the sudden drop will be nervous. Those who missed the chance to sell might use any bounce to get out. This tug-of-war can create a messy, unpredictable trading environment for days or even weeks. It's a time for caution, not for bold, hasty decisions. However, if we zoom out, the long-term picture appears more constructive. The fundamental reasons that drove gold higher haven't disappeared overnight. Silver higher hasn't disappeared overnight. Central banks are still buying gold. Industrial demand for silver is strong, especially from the green energy sector. The supply deficit is a real, physical constraint. These are not speculative factors. They are long-term trends providing a solid foundation. The bull market may have been shaken, but it hasn't necessarily been broken. This sell-off can be viewed two ways. For short-term traders, it was a disaster. For a long-term investor, it could be an opportunity. The parabolic melt-up made new buyers' entry difficult. This correction has reset prices to more sustainable levels. It has washed away much of the speculative froth and brought the market back to a point where value investors might get interested again. Gold as a pillar of stability is now more widely accepted by mainstream institutions. Ultimately, navigating this market comes down to your personal strategy and time horizon. Prices don't move up in a straight line. Chasing parabolic moves is dangerous. The market has given everyone a chance to pause, take a breath, and reassess. The days of easy, straight-up gains are likely over for now. While the immediate future remains cloudy, underlying support for precious metals suggests a brighter path ahead for long-term holders. My advice: stay calm and think long-term. Take a breath.